Welcome back, guys, to another episode from Coin and Capital. It's Chris here, and on this channel, we talk about macro, finance, economics, big picture theory, crypto, Bitcoin, whatever it may be. We give you guys headlines, the data, we break it down and deliver the truth. Today, general market update, get you guys right, get you guys ready for the week to come. Today is Sunday. What better day to put a market review? We'll talk about crypto. We'll talk about the states. We'll look at treasuries, see what's driving everything, break down key narratives, and get ready for the week. So let's get into it. Off the rip, guys, we'll start with crypto. Bitcoin. Nothing too crazy, guys. This week hasn't really been anything spectacular. We've been chopping for the last seeming like 2-3 weeks, right? We had the big run up in October, at the beginning of October, where we wicked 125K. And now, honestly, we've been just chopping around like 115 to 105. Nothing super exciting. The key technicals that we've mentioned in previous videos still hold. That being this inverse bearish fair value gap, right? So when we break through cleanly and retrace back in, that's a very good signal, especially on the daily chart, that order flow has flipped bullish. And then to the right, we look at ETF flows, because guys, now that institutions are here to play, these guys have the most capital, and they operate right now through these ETF wrappers as a method of controlling price until they get full regulation to trade spot. I think the SEC is working through that in November. But we can see here that ETF flows are still net positive on the month. So institutions have bought more than they have sold over October, which is great. That means institutions are net long Bitcoin right now. Even though the chart doesn't look super great, institutions are net long. And then let's check into my favorite altcoin this cycle, Solana. Same thing, guys. The crypto markets haven't really been super exciting. Just chop in a range. So for Solana, the range has been like 215 all the way down to like the 175s. But same thing, guys. We have that clean breakthrough and retrace to that inverse bearish fair value gap. Now Solana is a little tricky to read sometimes because it's so new and the market is so shallow. It tends to overshoot and undershoot pretty drastically when it comes to these fair values and premium discount ranges in the market. That's okay. Once you understand that, it becomes a little easier to read. To the right, though, we have a pretty strong narrative that played out quite nicely over the last week or two. And that has been Fidelity rolls out Solana trading access for US-based investors. Guys, Fidelity, one of the biggest money managers in the States, has just rolled out access to trade Solana through their brokerage platform. That's a pretty big deal, because now TradFi, who go through brokers, don't have to figure out the hassle of finding wallets running through DeFi. They can now just do it through Fidelity directly, for better or for worse. The way I see it, positive narrative behind Solana, price and deep discount. I think it looks pretty good into year end. To Ethereum, again, literally same thing. We've been chopping sideways 2 weeks. On the right, Standard Chartered sees tokenized real-world assets reaching $2 trillion by 2028. Vast majority on Ethereum. That's pretty cool, guys. The market cap for tokenized real-world assets, excluding stablecoins, is expected to expand sharply to $2 trillion by 2028 from about $35 billion today, roughly a 5,600% increase. That's pretty cool. Seems like a lot of these institutions like Ethereum for staking. It is cheaper on a carry basis and also building, probably for its robust security. Another positive narrative behind crypto. And something we also need to understand, guys, is a good chunk, if not the entire financial system, will be tokenized. Everything will move onto blockchains. Why? Well, because it's the better version of Swift, right? And we've finally built it from the bottoms up, starting with Bitcoin. And now blockchain has grown big enough to challenge the monopoly Swift has placed on payment settlements over the last, 50 to 80 years. Moving on, back into traditional finance markets, guys. We're taking a look at gold. This in from Reuters on the 24th. Gold funds saw a record weekly inflow as prices surged. Take a look at the gold chart. This is the daily. What are we seeing? A needed sell-off. I think it's a healthy sell-off because gold ran so much over the last couple months. I don't think the bid for gold is over. I think as the dollar continues to weaken over the next 6 to 12 months, and as geopolitical risks remain elevated, people, mainly traditional finance and China, are going to continue to flock into gold. Honestly, wouldn't be surprised if we see a 5,000 gold in the next 6 months, maybe even sooner. But this sell-off that's happening, I think, is genuinely healthy. Prices are just finding equilibrium yet again in this new macro environment before the next leg up. That's how gold has been working for the past 100 years. We have these massive run-ups where currencies are devalued, sideways, devaluation, sideways, devaluation, right? And I think that pattern's going to hold. Into the treasury market, guys. On the right, we have the 10-year as always. And then on the left, from Reuters yet again, U.S. gets rare earth reprieve from China, but not rollback. So China and the U.S. had this talk, this whole trade war going on, right? China said they'll pause their export controls. They'll pause. They're not going to take them away. They're going to pause, giving the U.S. a little bit more time to figure out what the hell they're going to do. And this treasury market, I think, expressed this quite well the last 2 weeks. We've seen a pop in the 10-year yield, risk off, right? When investors see risk, higher risk in the United States as a business, they demand higher yield on their debt holdings, right? So yields pop. But what we need to understand right now is that the U.S. Treasury is running buyback operations to keep these yields suppressed because they need to finance like $10 trillion of debt, right? And we discussed this. Doing that at a 4.5% rate is insane, absolutely insane. So the Treasury is creating all this new money to buy back these bonds to distort the risk signal the market is trying to show us. So I think over the next 2 weeks, 3 weeks, even the months to come, the buyback program will only increase and we'll see yields come down even further. This means that risk-taking environments get distorted. So what originally would be a risk-off month amidst all this geopolitical tension, the debt burdens of the U.S. and whatnot, this treasury buyback program distorts that and turns it into a risk-on environment, right? Where investors see low rates, they think we can take risk. Money is cheap now, risk is cheap, and liquidity floods into equities down the risk curve into crypto. Final slide of the day. This one I think is a little interesting. On the right, the US dollar weekly. I think this explains a bit of the constriction occurring right now in the market, especially crypto, things like Bitcoin, maybe even gold. Because the DXY, the dollar index, probably one of the best proxies for liquidity we have access to, right? As the dollar gets stronger, capital flow redirects into dollar-based instruments, so treasuries, the dollar itself, things of that nature. However, when the dollar gets weaker, then capital flows into equities, gold, crypto, down the risk curve again, right? So we can see the dollar has been chopping and slowly trending up a little bit over the last few weeks. I think that could be causing some constriction in the Bitcoin and gold markets right now that we're witnessing. And to match that with a headline, U.S. equity fund inflows eased before Fed decision and big tech earnings, right? Could be due again to this liquidity constriction coming in from the dollar rise. But also we need to understand that big tech does have earnings this week, specifically NVIDIA, right? And for those of you who don't know, big tech pretty much controls the entire S&P, right? The entire S&P moves off of like 7 companies now. So like Apple, Amazon, Microsoft, Google, NVIDIA, Meta. I think there's one more. I can't think of it. But anyway, Mag 7. That's what controls the markets, right? So everything hangs on their earning calls this week. And understand that the current liquidity backdrop is mixed. We have forces like the dollar tightening right now, whereas forces like the treasury buyback programs are actively injecting liquidity into the market. So it's like this tug of war function going on, which I think manifests itself in this price, right? Indecision is what we can derive from CHOP. And I think there's one clear path that comes out on top, which is going to be the U.S. needs to print the money to A, finance this debt, finance that 10 trillion, B, debase the current debt, because who's going to pay back 37 trillion? Nobody. C, reshore manufacturing, because who wants to rely on China anymore? China's not going to let them drop bombs, right? That's all they want to do. So there's 3 major drivers of why excess liquidity is going to override these choke points. But anyway, stay safe, stay away from leverage, maybe a little bit. Buckle your seatbelt because it's going to be an awesome week in the markets. And as always, if you guys enjoyed this video, comment down below, like button, hit that subscribe as well. And I'll catch you guys in the next one.